My name is Glen Turner. I'm the senior partner and managing director for Eagle Harbor Advisors, and I'm joined today by my partner, Girish Navare. And we wanted to spend a little bit of time and talk about one of the tenants that is, absolutely a focal point, critical to us here at Eagle Harbor Advisors. And if you've watched some of our intros, you'll know that Eagle Harbor Advisors, the name itself, really was built around that safety of the harbor. And then, of course, the eagle portion to represent oversight, vision. And one of the critical tenets to what we do and our philosophy here at Eagle Harbor Advisors is effective compounding, right? Einstein once said that compounding is the greatest invention known to man, and we believe that. But there's aspects to compounding that we can turn the concept of compounding into effective compounding. So today, we're going to be talking about effective compounding, understanding how risk affects compounding and sequence of returns, and how, in some case, relative to investments, how the tortoise can actually beat the hare. So I'd like to start and talk a little bit about compounding itself and the power of compounding. So G, why don't you kind of take that one and discuss the power of compounding?
Sure. As Glenn said, Einstein did say it was the greatest invention in the universe. Compounding is what? Growth on growth. So it's sort of a snowball effect that just gets bigger and bigger as time goes on. To think about it, if you had like a drop of water and you drop one drop and every minute is doubling, in 6 minutes you could fill up a room. Of course, there's two sides of compounding, and one has to be careful. There's the other side is if you have a period of time where the market values are going down, then that's effectively negative compounding. So that goes into the effects of risk and how that affects your compounding and the necessity to try to avoid losses in the market. And Glenn has a couple of points on that.
Yeah, I think some very simplistic examples drive home the point, right? So if we consider like a recent period of time that many people remember, 2008, 2009, where we had a severe market pullback, many portfolios were down in the 50% range. And the math is interesting, right? Because if you had a portfolio, an investment, and it was down 50%, so we'll use $100, down 50% is down to $50. So we examine what subsequent rate of return do you need to get that investment or that portfolio back to where it started? And the answer to the question is we lost 50% of the downside, and now we need 100% on the upside. We need to turn $50 into $100. So mathematically, the downside is absolutely critical to sequence of returns, right, and protecting and effective compounding. The key being not to suffer those real big downside losses, and we'll address that a little bit more towards the end of this and in subsequent videos. Just a last note on that, and I'll give it back to G to talk about kind of the value of avoiding those large declines. But as he said, it's compounded. So again, we'll go back to the 08-09 scenario. If your portfolio had suffered a significant decline and you were already in retirement and you were now using your portfolio to provide income for you. So to use an example, if you had a $3 million portfolio and we were drawing 5% off of it, which is a fairly reasonable number, it was providing about $150,000 a year of income to you. But now the capital base goes from 3 million down to 1.5 million. And if you continue to draw at that $150,000 level, we're now drawing 10% of the value of the overall portfolio. And that's just unsustainable. If that decline were to last for a few years where we didn't see the market rebound, the portfolio rebound quickly, it could frankly be catastrophic. So the sequence of returns when it happens is really critical. So G, could you spend a little bit more time talking about the value of avoiding those large losses?
Limiting the downside is more critical than any return you will achieve at the upside. So, for example, if we take a 50-year look back period, and I'm speaking a little hypothetically, but let's just to make a point that if you were to avoid any year that the S&P 500 was down, then on the up years, you would only have to capture 26% of the gains that the S&P posted. Now, clearly that's an impossible scenario, but it's making a point. If we made it more realistic, if you were able to say in any given loss year, limit your downside to 40% of what the S&P lost. So if the S&P was down 20, you're only losing 8. Then on the up years, you only have to have a 55% participation in the gain of the S&P. So there's two things happening here. One is that you're getting the same, if not more, return of them than the market, and at a significant lower risk. Until now, what we're looking at, okay, you want to take advantage of compounding, but you want to avoid the large losses and you want to avoid the volatility. And you can't, nobody's going to get it perfect, but to the best you can, then you're in a better position than you might. It's just intelligent investing.
Yeah, I think those are really great points, right? Nobody rings a bell, but the market sends pretty clear signals, right?
Yeah.
When there's higher levels of risk, I would say that we're living right now in one of those periods of time where the market is sending pretty clear signals. You know, where inflation is high, we've got issues with the U.S. dollar, we've got rising rates, we've got global tensions. So clearly, there's lots of risks out there, and those are signals that we heed. But to kind of draw together from a mathematical example again, you know, we can look at two different investments. And those two investments, if we look at the average return, for example, over a 10-year period, let's assume that they both averaged 10% return over a 10-year period. But one did it by going down 50, up 60, down 30, up 20, right? And we get to the end of the 10-year and we average it together and it averages a plus 10 versus the other side where you had one that did it just plus 10, plus 10, plus 10, plus 10 in each of the years. So we get the same average rate of return, but if you put $1 to both of those scenarios, what compounding does in that situation is it leaves you with a lot more dollars in the investment portfolio that avoided those large negatives. We can't avoid them completely, but we believe that with some reasonable expertise and reading the signs that are out there, we can certainly minimize it. So I'm gonna kind of wrap up this segment with an example. I love skiing, and I think this kind of brings it home to how risk and reward and compound, if you will, can be intertwined. So if we use the example of two famous skiers, one Hermann Maier, and the other is Ingemar Stenmark, both famous skiers. And if you look at the pure statistics, you'll find that Maier basically won 30% of all the races that he entered over his time in competitive skiing, and Ingemar won 25%. So on the outside, you would say, seems like Maier was the better skier. But you have to drill down further to really get the example. Hermann Maier was an excellent skier, but he also took incredible risks in his style of skiing. And as a result of that, he got injured much more frequently. And so he had to sit out on the sidelines. And I would equate that to if you're an aggressive investor and you suffer a loss like we did in 08, 09, and your portfolio goes down 50%, you might be waiting 5 years or 6 years before your portfolio is back above the point where you started. So for all intent and purposes, you sat out those races. You were not compounding. In the end, if we look at it, because of the higher injury rate that Herman Meyer suffered, he actually could only run 180 races and came out with about 54 gold medals, as opposed to Ingemar Stenmark, who ran 344 races and ended up with 86 gold medals. So basically 150% at the medal rate. So in this case, we really kind of saw the tortoise beat the hare in that rate to success, right? And that's what we're suggesting, that we can be defensive, we can maintain capital, we can preserve capital, make sure that we have it available to us, when we're healthy, when things are good, and we can get those better compounded returns.
That is a great example, and in terms of when you take a look at the number of races, and one has almost 60% more races than the other. Same thing in the market. You might have an investment that performs well over 1 year or over 3 years, but if it did really, really well, invariably there's 1 year where it does terrible. But then you have another investment has a longer track record, and it's not giving you those lights out years, but it's just consistently giving you 8-10%, whatever the number might be. And that's the other skier. That's
yeah. And in a day right now where we're sitting with 5.5% or 5%, on the Fed funds rate, we think it's a good time to stay healthy and sit tight. So we thank you all for your time and hope that you were able to get something out of this that will assist you going forward.